Price to earnings ratio, definition, formula, and examples by Jason Fernando. Jason Fernando is a professional investor and writer with enjoy tackling and communicating complex business and financial problems. Reviewed by Gordon Scott. Gordon Scott has been active investor and technical analyst for over 20 years, and he is chartered market technician. Fact-checked by Betsy Patrick. Betsy began her career in international finance, and it has since grown into a comprehensive approach to journalism as she's been able to tap into experience along with her time spent in academic and professional services. Definition price to earnings ratio compares a company's share price with its earnings per share. Analysts and investors use this to determine the relative value of a company's shares in side-by-side comparison. Key takeaways. The price to earnings ratio is the proportion of a company's share price to its earnings per share. A high PE ratio could mean that a company's stock is overvalued, that investors expect high growth rates. Companies with no earnings are losing money don't have a PE ratio because there's nothing to put in the denominator. The two most used PE ratios are forward and trailing PE. PE ratio are most valuable when comparing similar companies in the same industry or for a single company over time. What is price to earnings ratio? The price to earnings ratio measures a company's share price relative to its earnings per share. Often called the price or earning multiple, the PE ratio helps assess the relative value of a company's stock. It's handy for comparing a company's valuation against its historical performance, against other firms within its industry, or the overall market. Price to earnings ratio, a stock valuation metric that compares a company's share price to its earnings per share. How price to earnings ratio work? The price to earnings ratio is one of the most widely used by investors and analysts reviewing a stock's relative valuation. It helps to determine whether a stock is overvalued or undervalued. The company's PE can also be benchmarked against other stocks in the same industry or against its broader market. Analysis interest in long-term valuation tends to look at the PE 10 or PE 30 measures with the average in the past 10 or 30 years of earnings. These measures are often used when trying to gauge the overall value of a stock index, such as the S&P 500, because the longer-term metrics can show overall changes through several business cycles. PE ratio of the S&P 500 going back to 1927 has had a low of roughly 6 in mid-1949, has been as high as 122 in mid-209 right after the financial crisis. As of November 2025, the S&P 500's PE ratio was 30.36. PE ratio formula and calculation. The formula and calculation are as follows. PE ratio, market value per share divided by earnings per share. To determine the PE value, divide the stock price by the EPS. The stock price can be found simply by searching a stock's ticker on a reputable financial website. Although this concrete value reflects what investors currently pay for the stock, the EPS is related to earnings reported at different times. EPS is generally given in two ways. Trailing 12 months TTM represents the company's performance over the 12 months. Another is found in earnings release, which is often provide EPS guidance. This is the company's advice on what is expected in future earnings. This is different version of EPS form the basis of trailing and forward PE respectively. When to review the PE ratio, analysts and investors review a company's PE ratio to determine if the share price accurately represents the projected EPS. Forward PE. The most commonly used PE ratios are the forward PE and the trailing PE. A third and less typical variation uses the sum of the last two actual quarters and the estimates of the following two quarters. The following or leading PE use future earnings guidance rather than the trailing figures, sometimes called estimated rise to earnings. These forward-looking indicators help compare current earnings to future earnings, can clarify what earnings will look like without changing and other accounting adjustment. However, there are problems with forward PE metrics, namely companies could underestimate earnings to beat estimated PE when the next quarter's earnings are arrived. Furthermore, external analysts may also provide estimates that diverge from companies' estimates, creating confusion. Trailing PE. The trailing PE relies on passive performance by dividing the current share price by the total EPS from the previous 12 months. It's almost popular PE metric because it's thought to be the objective, assuming the company's reported earnings accurately. But the trailing PE also has its share of shortcomings, including that a company's past performance doesn't necessarily determine by the future earnings. Investors often base their purchases on the potential earnings, not historical performances. Using the trailing PE ratio can be a problem because it relies on a fixed EP figure. While stock prices are constantly changing, this means that sometimes significant affects the company's stock price, either positively or negatively. The trailing PE ratio won't accurately reflect it. In essence, it might not provide an up-to-date picture of the company's valuation or potential. The trailing PE ratio will change the price of a company's stock moves because earnings are released only each quarter, while stocks trade whether the market is open. As a result, some investors prefer forward PE. If the forward PE ratio is lower than the trailing PE ratio, analysts expect earnings to increase. If the forward PE is higher than the current PE ratio, analysts expect them to decline. Valuation from PE. In addition to indicating whether the company's stock price is overvalued or undervalued, the PE ratio can reveal how a stock value compares with its industry or a benchmark like the S&P 500. The PE ratio indicates the dollar amount an investor can expect to invest a company's receive $1 of the company's earnings. Hence, it's sometimes called the price multiple, can show how much investors are willing to pay per dollar of earnings. If a company trades at a PE multiple of 200x, investors are paying $20 for $1 of current earnings. The PE ratio is also help investors determine a stock market's value compared with company's earnings. That is, the PE ratio shows that market is willing to pay today for a stock based on its past future earnings. A high PE ratio could signal that a stock price is high relative to earnings and is overvalued. Conversely, a low PE could indicate that stock price is low relative to earnings. Example of the PE ratio that's clarity. Clarified with an example looking at FedEx Corporation. We can calculate the PE ratio for FDX as August 8, 2025 when company stock price closed at $228.05. The company's EPS for the TTM was 16.81. FedEx Corporation summary. Therefore, FDX PE ratio was as follows: 228.05 divided by 16.81 equals 13.57. Comparing companies using PE. Let's look at the two energy companies to see relative value. Marathon Petroleum Corporation has the following data as at a close of August 8, 2025. We will use diluted EPS to account for what could occur could all the convertible securities will be exercised. Stock price 160.84, diluted 12 months trailing EPS $6.88, PE 23.38, 660.84 divided by 4 by 6.88. MPC thus traded at about 23 times trailing earnings. However, the PE of 23 isn't helpful unless you have something to compare with, such as stocks industry group, a benchmark index, or MPC's historical PE earnings. PE range. PCE's PE ratio was slightly lower than the S&P 500, which as of August 8, 2025, was about 24 times 12 months trailing earnings. To compare MPC's PE ratio to a peer, let's look at the Hess Midstream. Stock price $41.64, diluted 12 months trailing EPS 2.69, PE 15.48, $41.64 divided by 2.69. When you compare MPC's PE of 23 to HESM of 515, MPC's stock could appear overvalued relative to the later but not the S&P 500. Alternatively, MPC's higher PE might mean that investors expect much higher earnings growth in the future than HESM. However, no ratio can tell you everything you need about a stock. Before investing, it's wise to use various financial tools to determine whether a stock is fairly valued. Investors' expectations. In general, a high PE suggests that investors expect higher earnings growth than those with a lower PE. A low PE can indicate that a company is undervalued or that a firm is doing exceptionally well relative to its past performance. When a company has no earnings or is posting losses, its PE is expressed as NA. Though it's possible to calculate a negative PE, it's not common. PE ratio is also standardized the value of $1 of earnings throughout the stock market. In the theory, by taking the median of PE ratios over a period of several years, one could formulate something of a standardized PE ratio which could then be seen as a benchmark and used to indicate whether a stock is worth buying. NA meaning. A PE ratio of NA means the ratio is unvaluable for that company's stock. A company can have a PE ratio of NA if it's newly listed, the stock exchange hasn't yet reported earnings. Such as with an initial public offering, it could also mean a company has zero or negative earnings. PE vs earnings yield. The the inverse of the PE ratio is the earnings yield, which can be thought of as earnings price ratio. The earnings yield is the EPS divided by the stock price, expressed as the percentages. PE vs earnings yield, PE vs PEG ratios.